All right, well, let's talk about markets. All right, anytime there's a market, there has to be both a buyer and a seller. So think of going to, I guess, a car dealership, for example. You walk in, you want to buy a car, you are the buyer, and the dealership is the seller. If the dealership did not exist, that means you're walking into some place and there's no supply, that means there's no market. However, just the fact that there's a buyer and there's a seller, that creates a market. Similarly, if there were only dealerships and there was no buyers, that means the dealership would not really exist, right? And so there would also not be a market in that instance. So with markets, there always needs to be a buyer and there always needs to be a seller. Now, why am I talking about car dealerships? It's because option markets, just like any other markets, there's always a buyer and there's always a seller. That's such an important concept, so you can understand what I'm about to explain in the next few videos. So let's jump into it. There are two types of options that we're going to talk about. There is the call option and there is the put option. So let's talk about the call option. So the call option, it gives the buyer the right, but not the obligation to buy 100 shares of a certain stock at a certain price on or before the expiration date. So this is from the buyer's perspective. Now remember the markets conversation we just had. If there's a call buyer, that means there must have been a call seller, or else this market would not exist. So if this call buyer has the right but not the obligation to buy 100 shares, then that means the call seller is obligated to sell 100 shares at a certain price on or before the expiration date. And so these two are on the exact opposite sides of the trades. This call buyer bought the call from this call seller. So if this call buyer has a right to buy 100 shares, that means this call seller is obligated to sell 100 shares at a certain price on or before the expiration date, if the buyer chooses to do so. And so the thing is, this buyer has to pay a premium to get this right. Now the seller gets to collect this premium to accept this obligation. So based on what you're trying to accomplish, you can choose to be either a buyer or you could choose to be a seller. Now let's look at an example. Let's say right now a stock is trading at $100. We're going to look at this from the call buyer's perspective. The call buyer thinks that the stock's going to go to $110 in 30 days, but they're not sure, so they don't want to actually go buy the stock. And so what they do instead is they buy a contract which gives them the right to buy stock in case it does actually go to a higher price. And so they choose to buy a call option with, let's say, $105 strike price. Now, what does strike price mean? If you remember from the definition, the certain price, that's what we're talking about. That's what this is. This is the certain price. So let's say the stock goes from $100 to $110 in 30 days at this expiration date. That means the person who bought the call option, they have the right to buy 100 shares at 105, even though it's trading at 110. So that means they can buy it at 105 and then they could sell it in the market for $110 and they would profit a $5 per share minus the premium that they paid to the seller. So if the premium was $2, then that means the call option buyer would have made $5 minus 2, and they would have made a $3 per share profit. And remember, each contract is for 100 shares, so that would have been a $300 realized profit if they ended up executing this position. Now let's look at what would have happened if the stock actually stayed below 105. Well, basically, if the stock number went to 105, the call option would expire worthless. Why would it expire worthless? It's because remember, the call option gives them the right to buy 100 shares at 105. So why would the call option buyer buy the stock at 105? Let's say stock's trading in the open market for 102. Makes a lot more sense to just buy it in the open market for 102 than to buy it at 105. And that's why that not obligation part in the definition is so important, because they're not obligated to buy it at 105, but they have the right to if they choose to. So if the stock's trading below 105, the contract expires worthless because it was only for 30 days. And so in 30 days, if it's not at 105, it goes to zero, and the person who sold the call option would have made money, which brings us to the call seller. So remember, these two are on the exact opposite sides of the trades, right? The person who bought the call option is buying it from the person who sold the call option. So again, we're going to draw this out. The stock right now is trading at $100. The call option seller sold the call option with a strike price of 105. Remember, they're the exact opposite sides of the trades. There's a seller right here and there's the buyer right here. And we're going to say in 30 days, the stock's trading at 110. So the call option seller, basically if the stock goes from 100 to past 105, they become obligated to sell the stock at 105. So the stock could be trading at $140, but they're still obligated to sell it at 105. So there is some risk there, because if they don't own the stock, what would that mean? That means they have to go into the open market, buy it for $140, and then sell it to the person who bought the call option at 105. So the call buyer would be very happy, but the call seller would be taking a huge loss if they didn't own the stock. But what happens statistically is that the stock will stay below 105. So what happens then? That means the call buyer would not exercise their option of buying the stock for 105, because again, they can buy it in the open market for 102. So that means in 30 days, their contract expires worthless and the call seller makes money. That means they get to keep the entire $2 premium. So let's compare this to a real world example without using stocks. Let's say there's this beautiful house here, and let's say here's a seller of the house and they list in the market. Now the buyer comes in and they want to place an offer on the house, and so they pay something called a due diligence fee. If you've ever bought a house, you know exactly what this is, right? So the buyer pays a little bit of money, so then the buyer can go and inspect the house. So if there's no issues with the house, they can go ahead and they have the right to buy the house. However, let's say they go and they notice a bunch of plumbing issues or electrical or just a lot of issues. They decide it's going to cost too much money to fix. What they could do is they can back away, as in they're not obligated to actually buy the house because there's too many issues and they don't want to deal with that. Well, this is basically a call option, right? It fits pretty much every definition. They have the right, but not obligation, to buy the house at a certain price on or before expiration. These due diligence fees last for anywhere between a few weeks to a few months based on the contracts. And so this is basically a call option. Now think of the seller. If the buyer decides to actually buy the house, that means the seller is now obligated to sell the house. Of course, there's a lot of fine print and it's not always going to be this way, but I think using this house as an analogy can help in cementing what a call option is. Initially, when learning about options, it can be very cumbersome, very stressful because there's so many moving parts, right? There's a buyer, there's a seller, there's a lot going on. So I'd recommend just rewatching this video. If you have any questions, definitely leave a question below and I'd be more than happy to help in any way I can. Awesome. Next video, let's talk about put options.